Hey guys, TommyBryson here, and I'm known on YouTube as the most boring investor there actually is. And in reality, when I first started investing, I wanted to be like everybody else. I wanted to make things very complicated and make some money. I wanted to use leverage. I wanted to go ahead and house hack and get some money here. I wanted to have a portfolio with a bunch of different stocks. I wanted to not have any cash because I wanted to use all the money all at once, obviously. But then with time, with results, and where I am today, I realized that boring is really the best way. When it comes to my portfolio, I have just three things. I have cash, I have real estate, and then I have stocks. And when it comes to my investments, they're not like I have some crazy amount of intricate types of investments like crypto and artwork on this and that. No, it's just really simple. And by the end of this video, you're going to be very surprised about how I make a little bit over $40,000, I think, like plus a year in passive income, without really having that much complexity whatsoever in my portfolio. Actually, you could see my portfolio and say, Tommy, I can do that. And the answer is, yes, you can, because it's not that difficult and it's not that hard. When it comes to the very good things in life, usually they tend to be simple. The complexity and the difficulty comes from you actually doing it for a very long time, all right? So in this video, I'm going to break everything down step by step and how much money this portfolio actually makes me every single year. All right, as always, guys, like this video on top out, also subscribe and hit the bell so you get notified. Now the very first thing is, guys, yeah, I hold cash. Everybody tells me, Tommy, cash is dead. You don't want to hold cash because cash gives you inflation. It erodes your values, not really doing anything. And by the way, confession, I have a little bit over $90,000 in cash, and this cash earns me a whopping $0. Like, I mean zero. I don't mean like 0.01. No, I mean $0. I don't make any interest whatsoever because where I hold the cash doesn't give me any of those benefits. Okay, so that basically means that this money doesn't produce for me any passive income at all. But in reality, hear this very carefully, guys. In reality, it also makes me all the passive income. And here's why. This cash that I basically hold allows me to have the option and the flexibility to be able to invest money without having to worry about taking money from my investments out. Now that is super important because people think that cash is only meant to be used, for example, for investing, but in reality, I have cash for my emergency fund, like 12 months worth. I'm thinking about making it 24 months. I also have cash for sinking funds. For example, if my car breaks down, I have cash for that. I also have cash for investments. Yeah, that's also one, okay? So I have cash that just basically sits there while I find some proper ways to actually utilize the money. Now, here's what I'll say, guys, okay? Sometimes the idea is, Tommy, you don't wanna hold on to cash. Just invest it into whatever you can so that we can make some money. But in reality, you don't want to put your cash into a speculative investment. For example, hey, I have cash. There's this terrible investment here, not that great, but at least it's better than cash. I'm gonna do it, boom. No, the answer is no. You better have cash there so when a good investment comes by, you're actually able to take advantage of it. Now, this is important because it is true. Cash is dead. Cash is not good for anything. It's just good for the option and flexibility. So if you do hold on to cash for way too long, that's going to be terrible. Whenever I'm holding on to cash, usually I'm thinking about like less than 12 months or like 24 months, but always less than 5 years, okay? More than that, you're getting into just your money is just eroding in value, especially when we have inflationary times like these ones right here. So overall, my cash earns me no money, like at all, but it gives me the option to keep investing. Thus, it earns me all the passive income I basically have. Now, number two, guys, is actually real estate. Now, I've been trying to get into the real estate market since forever, and it started back when I was like in New York, and I was going to buy this 3-family home, and I was like, okay, this is gonna be great. When I buy this 3-family home, it's a little bit over $700,000. I'm gonna put down X amount, and I'm gonna basically rent the top and basically make some passive income. Those people are gonna basically pay the mortgage. Pandemic hit. Okay, no one was paying anything, and thankfully that deal did not go through. So my entering into the real estate market came in a very strange way. My perspectives changed a lot, and I was less interested in a lot more leverage and a lot more ways to make money from other people's money. I was just interested in setting the foundation first. So I became more sensitive to debt and being involved in all that stuff. So my entrance into real estate came by me buying my very first personal property. Now you might say, Tommy, well, if you own a home, is that really an investment? Does it really earn you passive income? Because you basically live in it, like no cash is coming to you. Well, the answer is my home is valued around a low amount, $170,000. Okay, now I say that because I haven't had it appraised, but I know what it's sold for, and it's sold for like around $163,000. But after the improvements that I basically made to it, I can sell it for like probably like 180, 190. But I like to use very low numbers always when I'm appreciating assets, because in reality, when it comes to debt and for example, your income, you always want to use low numbers. When it comes to expenses, always use high numbers, okay? Because you don't want to do the opposite, because that's not great, okay? It's better to say, hey, this house is worth 170, it might be worth 190, but that's a good surprise, and to say like, hey, it's worth 190, and then you're like, oh, it's actually worth 170, okay? So that's why I use low numbers whenever it comes to assets. Now, overall, this home is paid for in cash. I don't owe anybody money on this home. It's actually my home. Now, the cool thing about real estate, which is kind of weird also, is that it appreciates, okay? So this asset goes up every single year in value, depending obviously on the market. But I don't really care about the market, for example, in years, like, oh, 1 year, 2 years, 5 years. Like, no, I care about the market in terms of like decades, okay? So that basically means 10 years, 20 years, 30 years. And over those years, the market tends to appreciate. And let's say, for example, my property goes up by 5% every single year. Well, if we use a standard calculator here, and I have, for example, $170,000 invested in there, well, 5% of that is around $8,500 every single year in appreciation. Divided by 12, that's around $708 in passive income in a sense. But the cool thing, or the weird thing, is that this money isn't real, because I don't really have this money. The only way I get this money is by basically selling this home and taking advantage of the appreciation, okay? But then there's taxes involved, and then I don't have a house, right? So it's like you have to kind of like equate these things. Now, the cool thing is, for me at least, in my personal situation, is that I'm staying in Puerto Rico for like 6 months out of the year, and then 6 months out of the year, I'm also staying, for example, in Dominican Republic, or for example, in other places. Now, this basically means that although this piece of real estate doesn't produce for me any physical cash, just appreciation, I do have the option of making it do that. For example, whether I do a short-term lease for 3 to 6 months with somebody to actually stay there, which I don't like the idea of, honestly, because that can be tricky. Or I can do, for example, Airbnb, which is basically while I'm here in the Dominican Republic, which is where I am, I could just basically Airbnb it out and make some cash, okay? And that can make me anywhere from like $800 to $1,200 a month extra. I know these figures and numbers because I have friends that basically work in the real estate industry and do Airbnb, and that's what they told me that property can basically make me. If I rent it out, it can be like $1,000, $1,200 a month. But then you have the idea that, well, if it's rented out fixed to somebody for those 3-6 months, then they have that. And then what do I do if I have to go back, right? So that's also a situation. But the good thing is that I do have options. But legitimately though, what you're looking at is around $708 per month off of $170,000 appreciation, although I did put more money into this property. Now, that's just a lot of numbers, a lot of information, but what you need to know is this. I have a property. It earns me money via appreciation, but that money isn't real because the market also goes down. But right now it's not really, so it retains its value. I'm using a lower number because you want to do that, because when you sell it, you won't be surprised in that sense. And that's basically it, guys. But I do have the option to rent it out or Airbnb it out because I do stay here for like 6 months out of the year also, which is pretty cool. Now, when it comes to stocks, well, here's the cool thing. I don't invest into dividend income stocks or, for example, into 13 different ETFs and 13 different index funds to basically have less risk or volatility or whatever. No, I keep it very simple. Now, overall, in my portfolio, I have the numbers where? I think I have the numbers right here In my stock portfolio, I'm using a book. Isn't that crazy? Like these, like paper actually exists, like still in 2022. Yeah. So I have a total amount of around $291,943, $46 invested into the stock market, and that's between three accounts: the 401k that I basically have, and also a Roth 401k, and also my normal brokerage account. Now, overall, between these three accounts, what you need to know is this: I'm only invested into one investment, and that is the S&P 500, the index fund form of it, and also the ETF fund of it, okay? Form of it. That's basically it. I don't have anything else. That's all I have. And the reason is not because, for example, like, oh my gosh, you want to keep it very simple. It's simplicity, but it's because that's also really all you need. If you think about it, the S&P 500 is the 500 largest companies in America. America has the #1 economy, and overall, this economy worldwide is so intertwined that if America fails, the whole world in a sense almost fails, okay? So, and the only way you actually end up losing is if we have like some big war, and if that does happen, then we still lose anyway. It's kind of like why play this game with all this stuff if in the end you can just do it this simple? And by the way, for me personally, this works, and here's why this works for me. When I first started investing, it wasn't like this. I had, for example, 7 different ETFs and 7 different index funds also. And then it went down to 5 different ETFs and index funds also. And then it went down to just one. And here's why. Because originally, volatility was very important to me. Whenever I saw a stock market go down, I would get a little worried. But then I realized that that was just what I thought, because when the market went down, I would get excited and I want to put even more money into it. And that's what happens. So if you do have a fearful nature in the sense that market goes down, you want to take your money out, you probably want to have some extra things in there to basically not have that much volatility. Volatility is basically when the market goes up and down, but risk is you losing your capital. So volatility, something going up and down, doesn't mean you're losing your capital. It just means that it fluctuates a lot. So risk to me is like minimal when it comes to the S&P 500, and I don't care about volatility because in a sense, volatility is my friend and allows me to put more money into the market at a lower price. So that's why I invest the way I invest. Now, overall, you might be wondering, Tommy, well, if you're thinking about passive income here, how much money in passive income do you actually make from this? The answer is very simple, but also very complex. If you ever watch a video and somebody tells you, hey, I make this much every single year from the stock market, they're not lying, but it's not accurate. And here's why. No one can say exactly how much money you're gonna make from the stock market, like at all, because it fluctuates. It's the market, okay? A lot of things happen. You don't know what's gonna happen, okay? So overall, all I can tell you is this, okay? Over the last 70 years, my investment, okay, into the S&P 500 has made around 11.88%. That's what it's made. So that basically means that this $291 something thousand is making me approximately, if we use those figures from the past, which don't guarantee the future, that's something people don't really like to think about, but it's a fact, okay? You're looking at, for example, $34,683 before tax. That's the actual passive income I actually make from this investment. Now, if you look at it per month, that's around $2,890, which, by the way, sounds like a lot, but remember, it's tricky because assets, to take the money out, you have to sell, right? Same thing with rental income, right? You might say you're not taking money out, you're getting paid, Tommy. But yeah, when you get paid that money, you gotta pay taxes on it. Everything has taxes, it's how the world works, okay? So overall, if we say I'm gonna get long-term capital gains tax of 20%, because again, I'm not really selling anything at all, you're looking at, for example, $27,746. That is what I actually get after taxes. Or, for example, after taxes, $2,312 per month. Now, here's the tricky part, because again, it gets tricky, and I want to tell you guys a full story here. If I were to say, well, that's pretty awesome, I'm going to go ahead and take that money out every single year, all right? What would happen is, if we had a down market, which we will have, it happens all the time, eventually I will run out of money, because if I keep taking money out at that rate, America is actually making me less money, then I could have the risk of running out of money. So the only way I'm actually able to take money out is taking less money than I actually make. And that basically means if I make $100, I take out 50. So that way I have $50 more in there to make me even more money so I don't run out of money. So my rule, not really my rule, the rule I've learned via finance is the 4% rule. You take out 4% of the investments, and that way you don't run out of money because it makes you run almost 12%. That's the idea. Now that's not all, because my asset here, which is via the stock market, it does produce for me some dividend. And dividend is what I make, right, by getting a portion of the profits from these investments, okay? So what I make in dividends is about $5.81 per share that I actually own. Now, this gives you a yield of about 1.59% currently at a price around $366. But the thing is, I did not start investing today. I've been investing for a while. And whenever the market goes down, I invest more. Got a problem. I just like investing, okay? So I actually bought in at an average price of around $300, meaning I'm making money right now while people are basically losing money. But overall, this basically gives me a yield, adjusted yield, of about 1.94%, which is actually pretty cool. So when you take that and you multiply it by $291,000, that gives me just in dividends about $5,663 or $471 not adjusted for taxes, which is actually a pretty good amount. Now this money I could basically get every single quarter. Every quarter means, for example, every 3 months, okay? Because they actually send out that check to me. But what I choose to do with that check, again, I'm a boring guy. I don't really need the money. So what I basically do is I'm going to tell you by the end of this video how much money I actually need to have a very fancy lifestyle, and you will be surprised, okay? But what I actually do with that money is I leave it in there and I have the money reinvest itself and keep doing what it does, okay? Because the goal is to build up a castle. So the risk of me actually needing the money or losing money is actually very low and very minimal. But again, we could have a down market for a very long time. So it's a part of the game that we all play when we're investing money into the stock market. So I understand the risks, and that's why I play the game the way I play the game, because I understand the game. Now, overall, here's what I've learned. When it comes to building wealth or passive income, it's not about having a lot of it. It's about having enough of it. So for me personally, I could live a very good lifestyle just with $1,000 per month. I really mean it, and here's why I mean it, because that's how I live today. I live with $1,000 per month. But the thing that allows me to live this way is basically saying, hey, I don't have to pay a mortgage, I don't have to pay a car loan, and I don't really have any debt. So by me being like this, I don't really need that much money, and that helps me out a ton. So for me personally, I don't need that much money because I just basically live a very boring lifestyle, and I like it. I like the way I live, honestly. But for you or anybody else watching this video, you might say, well, Tommy, I need $12,000 per month to live a nice lifestyle. But then you gotta do the math, and the math is not something you like when you do these big numbers, okay? People really like big numbers, but they cost a lot of time, a lot of work, a lot of effort. It's not usually worth the squeeze, okay? So overall, just for fun here, before I leave this video and I leave you guys here, if you need $12,000 per month, all right, multiplied by 12, that's around $144K a year. It's a lot of money. Why would you need that much money? Like if you have a paid off home, a paid off car, and all this stuff, I don't know, okay? But if you divide this by 0.04, that would basically say, well, I think I did that wrong. 144,000 divided by 0.04 gives you around 3.6 million. So you would need a portfolio with $3.6 million if you want to make that passive income from the stock market. It's a lot of money, and that's not even accounted for taxes. So it's probably going to be even more money. But for me personally, because all I need is $12,000 a year, if I divide that by 0.04, well, I only really need around $300,000. And I'm basically there, okay? So that's what I'm saying. So overall, my portfolio size is a little bit over $555,000, and it's awesome. I give thanks to God for it. But overall, what I've learned the most when it comes to wealth building is that really the things that make you happy in this life are not going to be monetary. Like, they give you the option to do certain things, but even that happiness is fleeting. And I learned that. So for me personally, what money gives me the option to do is to have the freedom to do the work I love, which is this, to be able to be with my family, to help people. I told you I'm boring. All right, that's what I like. But interest, as far as like I want to be in Dubai and I want to do that, I just don't really care. But that's me. So you design your life according to what you like and what's reasonable and what you're able to basically pay and sacrifice for it, and then you kind of just make it happen step by step. My one piece of advice, we made it all the way to the end of the video, would be enjoy the journey. because this whole goal thing is kind of like pretty cool. Like I want to have $1 million, but what it actually takes for you to have $1 million to build that character, to go through those experiences, that's the actual success of actually getting that thing. So don't just focus on the end, focus on the whole journey and enjoy it. I think Jim Rohn says that, and Jim Rohn is very good. It's like me, like this year, like for me to be able to run my first marathon, which is just about like 26.2 miles, I had to run over 1,000 miles. So imagine if I was not happy doing those 1,000 miles, like the 26.2 miles wouldn't be that sweet. So you got to enjoy everything about it. Guys, that is it though, okay? Sorry for keeping you that long. I just love talking to you guys, okay? As always, guys, like, subscribe, hit the bell so you're notified. Comment down below anything you guys are going to comment. Or no, comment down below passive so I know you made it all the way to the end of the video. Up here is another video. Over here's my faithful subscribe. And as always, long-term team officially out. Maybe I should call us long-term boring team. Maybe. Who knows?